Thank you for that question. There's a lot of public perception that ESG is predominantly driven by retail investors who are investing in ESG funds, which are first thinking about as being doing well by doing good, and secondarily as driving out performance in their portfolios. While those funds have seen net outflows in the US, globally this hasn't been the case. But more importantly, the factors that are driving ESG adoption globally are not necessarily voluntary investment strategy decisions, but they're actually regulation and the need to report on ESG variables, as well as investor policy mandates, meaning institutional investors that are expressing a desire to invest sustainably. The origins for this are within the UN Principles on Responsible Investment, which for, let's say, investor policy mandates, they have actually created a policy that as of May 2023, 727 asset owners have signed. Basically, a large concentration of global capital is managed by asset owners who are aligned to responsible investment principles. And on the regulation side, sustainable investment regulations have exploded in the last 20 years, meaning now that investors have to report to their stakeholders on a number of sustainability variables, meaning they need to adhere to ESG alignment. That's an excellent question. ESG ratings in particular have come under fire due to the perception that different ratings are producing different outcomes in terms of how sustainability is assessed. What Chartis is finding is that ratings providers that concentrate on providing transparent and auditable ratings offer more objectivity to investors. Of course, there will be differences in sort of data, as data is not completely reported currently, but on the data side, data is getting better every year due to increasing corporate disclosure. So what Chartis is seeing is that increasing corporate disclosure and better quality data, along with objective and transparent processes, will yield ESG ratings that are more robust and resilient to scrutiny. So our core takeaways in this report are that materiality is one aspect that investors need to think critically about. The current standards for materiality are crafted by a industry consensus, but are not necessarily experimentally linked to sustainable investment risk. So essentially what investors need to be looking at is which factors do they consider material, and are these aligned with their data and scoring sets? And if not, they need to be thinking about how can we get data that is material on ESG and how can we align our portfolios to it. And this will take perhaps a more fact-oriented approach to ESG or a more deep fundamental approach to ESG in order to integrate materiality in valuation and cash flow models.